Welcome back to Key Talks, guys. Today in this video, I'm going to be talking about the things that I learned from the great Warren Buffett. So, without further ado, let's talk. Alright guys, so let's get right into it. Number one, never depend on a single income. Instead, make investments to create a second source. Now, why is this important and what did I really learn from this quote? You see, I used to think that investing was only something that smart people did, and clearly I'm dumb. So I just never did it for the longest time. But then I realized something. People make investment decisions every single day and they don't even realize it. You see, investing isn't just about money. When you put your time into something, when you put your effort into something, you're investing in that thing, whatever it is that you're doing, because you're investing in things that matter to you. So those are investment decisions that you make on a daily basis. This quote isn't just talking about buying stocks. It's also talking about your time, and spending time is a big investment. You see, you can spend time on doing a side hustle, growing your network, and building relationships with the right people. Well, guess what that means? That means eventually those right relationships or those networks, they might actually translate into real dollars. And I've seen this personally in my own experience, where I tried to do a side hustle, build relationships with people, and then I end up making money. And it's a great feeling because I invested my time. Instead of sitting at home watching Netflix, I went out there and then I made an effort on something that I actually cared about. And that is considered an investment decision. So number two, if you buy something that you do not need, then soon you're going to need to sell something that you actually need. Now, this quote is very, very powerful. Overspending in general on things that you don't really need is going to cause you a huge problem down the road. Because if that thing that you're spending money on doesn't actually give you real value in any aspect of your life, then what's going to end up happening is you're actually cutting down on money that you actually need for yourself. Let me give you an example. Let's say you make a certain amount of dollars every single month and you've already budgeted and you saved a little bit of money to go buy a Louis Vuitton bag. But by buying that Louis Vuitton bag, you know what? Next month, maybe, you can't get the coffee that you buy every day. Now you're going to have to make the coffee at home, even though you actually love, the whole atmosphere and environment of going to a coffee shop. And things like that will actually impact you in a negative way. You're going to want to spend the money anyways. So either you're going to have to not spend the money there, or you're going to spend it and you're going to drive yourself into a little bit more of a debt situation, which is not really great. The important point here to take away is finding out what actually brings you value. And that's what this quote does for me. If that thing that I want to buy doesn't give me value in my life, there's no point of getting it. There's no point of buying it because there's no actual value that's going to impact me in any way. Point number three, cash itself is a bad investment. What am I talking about here? Or rather, what does it mean in Warren Buffett's situation? You see, when Warren Buffett holds cash, or when people or articles or things you read online say that Warren Buffett is holding mostly cash right now, what does that mean? It doesn't actually mean he's holding physical dollars in his checking account. What he's actually doing is he has cash equivalents. So he has T-bills, bonds, or accounts that pay him a good amount of interest on his money. Because cash itself is a devaluing asset. It's a bad thing to have because it's not growing and inflation is rising all the time. So then really you're losing money by just holding cash itself. Any savings you have should be at least in a savings account that's earning some kind of low interest, rather than putting it in a checking account that's charging you $20 a month just to have the account open. Right there, you're not only losing money because it's devaluing, but you're also paying for the fees to have the account open. Versus if you have a savings account, it's much more beneficial and you're earning something better than earning nothing. The next few points that I'm going to be talking about is more related to the investing side. And with that, number four, invest by facts, but not emotions. The main reason why people buy at market tops and sell at the market bottom is simply because of this. They're driven by emotion. When you hear something bad in the news or your friends are selling, the first thing you want to do is sell, even though the stock is crashing and you probably shouldn't be selling. Understanding simple approaches like diversification and dollar cost averaging are very key. Those are two approaches that investors can take to implement consistent decisions that are not driven by emotion. Staying the course through short-term volatility is often the key for longer-term success. And I take that to heart when I'm making my investment decision. Am I investing something driven by emotion, or am I investing in something based on the facts? And this goes both in your life and when it comes to stocks. When it comes to stocks, I'm looking at the balance sheet, the numbers, the debt. I want to see if the revenue is consistently growing, and a bunch of points like that to see if I have conviction in it, this company is going to continue to grow. And if I believe in it and I believe that this company has a great valuation, well, guess what? I'm going to keep dollar cost averaging in it even though the stock is falling. But what about in life? Well, in life, ask yourself, are you doing something because you're mad and you're angry and in actuality it's not even productive for you to be doing it? Or are you doing something because it's a fact? Like you going out there and grinding, let's say you're, mowing the lawn, because, I can't think of any better examples right now because I'm dumb. But let's say you're mowing the lawn and you get paid $20. Well, it's not something fun. There's no emotion involved in there. But there's a fact that if every lawn that you mow, you make $20. Well, guess what? You're going to probably knock on every door to try to see if you can, cut more grass. That way you make more money. That's an investment decision where you're putting your time into something and you're going to be successful in that. But then let's say you're mad and you cut someone's grass and they gave you $5. They undercut you instead of giving you the $20. Are you going to go and burn their backyard down or their front lawn down? No, you're not going to do that. You're not going to do something driven by emotion, because making that stupid decision will probably ruin your entire side hustle, because everyone will know that you're the guy that burnt the lawn. Clearly, because again, I'm bad at picking examples because, yeah. Whoops. All right, guys, point number 5. Invest in productive assets. Assets that are cash flowing. You see, there's a lot of hype and speculation because, it's really fun to buy things that are, talked about a lot. But there's a lot of hype around companies that pretty much make $0. And if you're investing in companies that make no money, well, basically you're buying something for $0 or usually a negative return. Well, let me just talk about what a productive asset even is. The point is, a productive asset is an asset that just makes money and it's cash flowing. There's cash coming out of it nonstop. But then a lot of people want to buy companies that have complete hype around it and they have zero revenue, but they're going to next quarter, they're going to make like 50,000 cars or $50,000 in revenue, or maybe $50 million in revenue, yet they've done nothing to prove that they've made any money in the past. So how could you believe that they're even going to make money? And the problem with stocks like this is that I've experienced this, if I buy a company that has $0 in revenue and it's overly hyped up and it's already pretty expensive and everyone's saying, no, it's going to go higher, well, guess what? If it can go that much higher and it's already gone this high right now, the downside is extremely, extremely dangerous. It can go high as much as it can go low. And that's a dangerous thing. If you buy something you think it's going to double in price, well, you can lose more than half of it. It can drop 90%. You really want to be doing that? It's better to buy stocks and companies that are not overvalued or overhyped. Because if you're buying stocks and companies that are not overvalued or overhyped, then the downside is extremely low. How much lower can it really go? There's such a limited amount that it can go even lower. And then if it does, then you actually want to buy more and dollar cost average into it. So because of that, it's really, really important to understand that you want to be investing in productive assets, things that pay cash flow and that are profitable. And this leads into point number 6. Don't sell a stock unless the company's fundamental or the business's fundamental changes. You see, Warren Buffett's principle is to buy wonderful businesses. So what does that mean? Businesses that are doing great, that are, thriving, that are keeping the customers very happy, and they're making money, have low debt, and all of these other things. And when he buys wonderful businesses like this, Warren Buffett doesn't really sell. You see, even if they are slightly overvalued, he doesn't sell. He just doesn't do anything. He holds it and then he waits until it's below, intrinsic value so he can buy again. And that's all he keeps doing. And this is pretty much his way of compounding that money so he can make more money. And this is how he's grown his wealth. So if I buy a business that I believe in and it's a wonderful business, I can keep buying it again and again and again. And that buying will eventually compound for me and benefit me in the future. All right, guys, let's talk about number 7. Invest in things that you understand, not things that you don't understand. Just because Joe Blow over there, hey Joe, tells you to buy this, hyped up like AI, cow manure, technology, stock, doesn't mean you should go buy it. You know why? Because you don't know anything about AI, cow manure, technology, right? I don't know anything about that. So why am I going to buy something that I don't completely understand at all? Now, if I wanted to take the time to research it and really try to understand what they're doing and what's going on, then sure. But if it's not my area of expertise, there's a loads of other investments that I can make versus investing in something that I don't understand. Because when you invest in something you don't understand, you're not investing, you're gambling. There's a clear distinction between investing and gambling. And majority of the people out there, they're not investing. They're gamblers. They're just gambling. And you don't want to be in the shoes of a gambler because it never goes the way you want it to. Let's say you get lucky and this cow manure AI stock shoots up to the moon and you made like a 50,000% return. Well, guess what you're going to do? You're going to take that money, you're going to get greedy, you're going to do it again and gamble on the next thing, and you're probably going to lose it all. Why? You don't have a process. You don't have a strategy. You're not buying things that you understand. Because of that, you're eventually going to lose it anyways. Therefore, you should only invest in things that you understand. And this quote is a very important quote from Warren Buffett. And I feel like, I've learned the hard way. I used to throw my money at stocks all the time, here and there, like nothing, because, I didn't know what I was doing for the longest time. But I'm not like that anymore. Now I dive into a business. I see if I understand the business. If it makes sense to me, I'm going to buy it. If it doesn't make sense to me, I'm not even going to look at it. All right, guys. Number 8, too much diversification is not good. Now, I know this is kind of a hard line to understand, and I'm going to explain it because there's guys out there like Ray Dalio, who's really, really smart, and Kevin O'Leary, who's really, really wonderful. Get it? Mr. Wonderful. And both of these like high net worth individuals will tell you that you need to diversify and diversification is key. Yet somebody like Warren Buffett will say over diversification will kill you. So why is that? Well, what I want to talk about is who Warren Buffett is directing this message to. You see, Warren Buffett, he's talking to the average, Joe Blow over there. Hey, Joe, again, who pretty much knows nothing about investing at all. And if Warren Buffett has to give advice to somebody who doesn't really invest and know anything and has maybe is like, middle class or lower middle class and has just a little bit of amount of money in their savings, he's going to tell them not to over diversify and buy 50 stocks. He's going to tell them just put your money in one thing, and that one thing should be an S&P 500 index fund. This is what Warren Buffett says. He says diversification will overall kill you. And if you are a stock investor and you want to buy individual stocks, then it's better to buy something that you understand, that you believe in, that has a huge history of being profitable. Like right now, companies like Apple and Facebook, you can just dollar cost average into that. And then if you buy 50 of them, well, overall, some stocks will be down, some stocks will be up. So you're not going to be up overall. But then if you only buy 2 or 3 stocks, then you're going to see a huge upside in your portfolio. And this kind of strategy will help people in that income class earn more money and start to help them grow their portfolio faster. But when it comes to high net worth individuals, they can't be taking those kinds of risks because the amount of money that they have is in the hundreds and millions of dollars. So if they're going all in into Tesla stock and they only have $100 million in total and they liquidated everything just to put it into one stock, well, that's stupid, all right? But if you're making $50,000 a year and you got like $5,000 and you want to, buy one stock, that's not stupid at all. So there's a huge difference. So the way I see it, for wealth preservation, when you already have money, yes, what Ray Dalio says is correct. Yes, what Kevin O'Leary says is exactly correct. But when it comes to people who haven't made enough money to even have a net worth, because most people have negative net worth, especially if you have student debt, right? Well, for those individuals, I feel like this quote really goes a long way with them, that diversification is not the key in the beginning, and that you do want to just stick with 2 or 3 fundamentally wonderful businesses that you can invest in. And I think Warren Buffett is a genius in preaching that. He's not directing his message to high net worth individuals. He's talking to the everyday Joe Blow. Number 9, when you see great opportunity, take it. This is an amazing line, and I really learned from it because a lot of the times I'm very doubtful, right? Sometimes you don't believe in yourself, you're doubtful, you think you can't do it, or, oh man, this is such a great business idea. You know what? It would be such a perfect time to do it, after the pandemic or after this happens or even right now. But yeah, it's good for somebody else. Maybe Joe Blow. I gotta stop using Joe Blow. I gotta pick a new name, I can't think of one now, but I'll think of one eventually. Anyways, the point is, people are doubtful about themselves, and then you don't give credit to yourself. But you need to believe in yourself. You need to give yourself credit. Because if you give yourself credit, you're gonna do the thing that you said that you can do. And then when you do it and when you become successful, you're gonna, be proud of yourself for it. You're gonna be so happy you even took the chance on yourself. So definitely believe in yourself. And when you see that great opportunity, take it. Now, when Warren Buffett was talking about this, he was obviously talking about stocks. Sometimes he knows that a business is wonderful and he knows they have the perfect number and is trading below intrinsic value and that he wants to buy it, but he'll hesitate. He'll hesitate because he's doubtful. And he's learned the hard way that, he could have made so much more money if he had actually bought it, but he didn't. And number 10, this is a famous quote, right? And this quote is about avoiding the herd mentality. Be greedy when others are fearful and fearful when others are greedy. I'm pretty sure you guys already know what this quote means. If you don't, well, let me explain it to you. When everybody around you is doing one thing and it's the same thing, it doesn't necessarily mean that you should be doing it, because you're probably buying at the market top, especially when it comes to stocks. You see, this happened during the dot-com bubble, right? In the early 2000s, late 1999, what happened? Everyone was talking about tech stocks and they were buying like pets.com, this.com, that.com, every stock that made $0 in revenue at the time. And what ended up happening? Well, they all crashed. Why? Because everybody was super greedy then, and they just wanted to buy every single tech stock that came out. And if you did the same thing, you would have lost a lot of money. What about being greedy when everyone's fearful? Well, what happened after the dot-com bubble when everything crashed? Or what happened when Bitcoin crashes in 2017 or in 2013? Well, now it's trading at a pretty good price. It's pretty low, and it stayed at the bottom for a while, and everyone tells you to stay away from it. That's probably the best opportunity for you to go in and buy it when everyone else is telling you not to buy it. Because that's how you really make the money. And that's what he's done in his career to make a crap ton of money. Number 11 is associating yourself with people that will cause you to move in a better path. Now, as soon as I heard that, the first thing I'm thinking in my head is, okay, well, basically Warren Buffett's telling me to cut out all my friends, right? No. Well, not necessarily. See, what this quote means is find those people that you want to be like, or build those right relationships where you're able to build a relationship with someone that's going to move you in the right path. If you're not able to do that, let's say you're in a terrible situation, there's absolutely nothing you can do to, move with the right people. Well, your brain doesn't actually know the difference between what's real and what's fake. Now, why am I saying this? Well, this is why. See, I felt like I was in a situation where I didn't really know who I'm supposed to be associating with, what the right people are. Like, what does that even mean? The right people, move with the right people that will, help you move in the. But what am I saying? Associate with the right people that will help you move in the right path. Like, what does that even mean? But then what I started to do is, because I know my brain can't tell the difference between what's real and what's fake, I started listening to podcasts about personal finance instead of listening to music in the car. I started reading books about personal finance instead of reading fiction books about, Lord of the Rings or whatever. I started reading books on personal finance instead of reading nonfiction books. I started talking to my parents about, the podcast that I listened to and something that I learned, instead of just talking to them about, what the next door neighbor did or whatever. And by doing these kinds of things, I started to get influenced more and more and more. Even on social media, I stopped liking, fast cars, and I started liking those motivational success posts and things like that. And that just got projected onto me even more. Eventually, my brain couldn't tell the difference really, and I started seeing more influences that were related to business, success, personal finance than I did anything else. But that actually helped me in a big way. And I wasn't physically able to associate with the right people in the beginning to help me move in the right path, but what I did is I changed my influences. So then now when I was associating with the internet, I was associating with the right people on the internet. And that helped me do things like make this YouTube channel. That helped me do things like start my side hustles and my businesses. That's what I would tell anyone else who's trying to figure out what this quote means to them, because this is what it means to me. All right, guys, so that was 11 points that I gave you on things that I learned from the great Warren Buffett. Thank you guys so much for watching my video. If you haven't already hit that like button, well, you know, there's something called a YouTube algorithm, and it kind of only works when you hit that button. So make sure you hit it. Thanks. Thank you guys so much for watching this video. I really do appreciate it. Like, subscribe, hit that notification bell, and I'll talk to you guys soon. Take care.